Welcome to This Explainer. Okay, let's dive right in and build your ultimate auditor's toolkit. If you're tackling the ACCA Audit and Assurance exam, or, if you just want to understand the true bedrock mechanics of a financial audit, you are in exactly the right place. Today, we're going to systematically break down how an auditor confidently identifies and tackles material misstatements. We're turning all that complex theory into a highly practical, structured toolkit so you can navigate those tricky exam traps and real-world scenarios alike. Let's get to it. Here is our roadmap for today. We'll start by setting the materiality threshold, then we'll calculate audit risk, test assertions, evaluate internal controls, and finally, test those controls in practice.
All right, let's kick things off with part 1, setting the threshold, also known as materiality. So before an auditor does anything, we have to establish exactly what size of an error actually matters. Materiality sets the stakes for the entire audit process. I mean, it's not just about hunting down every single missing penny, right? It's about identifying the misstatements, whether that's one giant error or a cluster of tiny ones, that would reasonably change the economic decisions of the users. Basically, if an error wouldn't change an investor's mind, it's just not material. This concept literally defines our baseline for the entire audit.
But how do we translate that somewhat abstract concept into a hard numerical threshold? Well, we use standard mathematical benchmarks. We can't just guess what might sway a user's decision. Typically, auditors look at about 5% of profit before tax. Now, for nonprofits or maybe companies operating at a loss, we might pivot and look at 1% of revenue or total assets, or roughly half to 1% of equity. This gives the audit team a highly concrete dollar amount to work with when they're out there deciding what to actually investigate.
Now you might be wondering, what happens if a bunch of little errors sneak by? This is where a vital safety measure comes in, performance materiality. Your overall materiality is that big, overarching number we just talked about. But if we only look for errors of that exact size, a bunch of smaller, hidden errors could easily slip through, add up together, and break that threshold. We call that danger aggregation risk. To fight this, auditors use performance materiality. It's essentially a safety buffer, usually set between 50 and 75% of the overall materiality, and we use it during our day-to-day testing. It just makes sure the little things don't sneak up and become a massive problem.
Moving right along to part 2, calculating the threat, which brings us to audit risk.
To map out the threat landscape of any engagement, we rely on one absolutely foundational formula. Audit risk equals inherent risk times control risk times detection risk. If you're prepping for the ACCA AA exam, this right here is non-negotiable. You absolutely must understand how these 3 specific puzzle pieces fit together to create the total risk profile of your audit.
Let's break those down. Inherent risk is the raw, natural susceptibility of an account to be wrong, completely ignoring any safety nets. Like highly complex foreign currency transactions, huge inherent risk. Then we have control risk, which is the danger that the client's own internal safety nets fail to catch an error. Now, as an auditor, you can assess these two, but you can't change them. They are what they are. However, detection risk, the risk that your own audit procedures completely miss the error, is the only dial you can actually turn. If inherent and control risks are dangerously high, you've got to actively lower your detection risk by doing more work. Think larger sample sizes or bringing in more experienced staff.
Okay, part 3, testing the truth with assertions.
When management hands over their financial statements, they aren't just giving you numbers. Actually, scratch that. It's more like they're making implicit promises or assertions about those numbers. We split these into 2 main buckets. First, classes of transactions. These cover events that happened over the year, like your sales or purchases. Second, account balances. These are the static, year-end numbers, like inventory or receivables. And to remember how to test these, we use some incredibly effective memory hooks, the mnemonic PI for transactions and CAR for balances.
Let's zoom in on transactions for a second and unpack that PIE acronym. It's a high-yield memory hook that links every single audit procedure you design back to a concrete goal. Occurrence proves a recorded sale actually happened, meaning it's not some ghost transaction. Completeness is the exact reverse. It makes sure every real sale actually made it onto the books. Accuracy ensures the math is spot on. And cutoff, which, by the way, is a massive topic for exams, proves the transaction was recorded in the correct financial year. Just remember, every procedure you write must target one of these specific assertions.
Which brings us to part 4, the client's first defense, internal controls. So,
Think of the 5 COSO components as the fundamental layers of armor designed by management to ensure reliable reporting and to stop those material errors dead in their tracks. It all starts with the control environment, often called the tone at the top, because let's face it, if management doesn't care about the rules, no one else is going to care either. From there, they have to assess their own risks, maintain a solid information system, implement specific control activities to catch or prevent errors, and lastly, monitor the whole shebang to make sure it's actually working week after week.
But how do these abstract ideas look in the real world? Well, authorization means someone in charge actually has to say yes before spending money. Segregation of duties is a huge one. You never ever let the person who orders the goods also pay for them. That is literally just asking to be defrauded. Physical controls are exactly what they sound like, putting a padlock on the warehouse door or having strong IT passwords. And reconciliations are simply making sure 2 independent sets of records actually match up at the end of the day.
And finally, part 5, testing those controls in practice.
Now, if you want to absolutely crush the ACCA AA exam and frankly survive real-world audits, you need to use the DIRT methodology. It's your blueprint to flawlessly handle any control deficiency scenario. When you spot a weakness, first state the deficiency. What exactly is missing? Next, the implication. What's the real-world risk of fraud or error here? Third, offer a recommendation, a realistic way to fix it. And finally, design a test of control to prove your recommendation is actually operating effectively. DIRT is the ultimate cheat code for structuring high-scoring answers.
For that final test of control step, you've got to use strong, direct, active verbs. Never just say you're going to check something. That is way too vague for an auditor. Instead, you inspect a document for a signature. You observe the warehouse staff physically separating duties. You reperform the bank reconciliation yourself to see if their math holds up. And you inquire by asking management questions. Just keep in mind, inquiry on its own is the absolute weakest form of evidence. You always have to back it up by inspecting, observing, or reperforming.
So, we've defined our threshold, mapped the risk equation, targeted assertions, evaluated controls, and applied the DIRT method. You now have the ultimate blueprint. But I want to leave you with a final thought to take into your next exam or client engagement. No matter how incredibly well-designed a company's armor looks on paper, where is the human element going to step in and cause that exact system to fail? Stay skeptical out there, and happy auditing.